Okay, so I said that there were two ways of financing with accounts receivable. We looked at the first method, which is to borrow money and just use the receivables as collateral. And the second one is actually selling accounts receivable. And the term we're going to use for that is factoring. Um, so factoring is the process of selling your accounts receivable. When we use the word factor, it's a noun and it means a financing institution that is someone who buys accounts receivable from another company. So in order for us to factor, we have to meet the three conditions. Remember, those three conditions essentially said we have to isolate the receivables from the transferor, we have to have no underlying repurchase agreements present, and that the person who is receiving the receivables, the factor, is has the beneficial interests in those receivables. They can sell them and do what they want with them. There are two flavors of factoring, either with or without recourse. Recourse indicates continuing involvement in the receivable. So factoring without recourse or sold without recourse indicates that we, the seller, are not going to be responsible for uncollectible accounts. So the recourse is on the part of the factor. Because if we sell with recourse, then the factor can come back to us if we're the ones who sold the receivables and request that we cover the ones that are uncollectible. The purchaser, the financing institution, will assume the risk of collectability in a without recourse situation and absorbs any losses associated with those uncollected accounts. The players that are involved, what the accounts we're going to record. One is the cash account. It is what we collect from the factor, and typically it's going to be expressed as a percent of the receivables that are sold, sort of like what we saw in the assigning, where a percent of the receivables we assigned was forwarded as cash, advanced as cash, and then we paid back. In this case, however, of course, we're not going to pay them back. We're selling the receivables outright, and so we remove them from our balance sheet. Therefore, there is no liability of a note payable that is outstanding in a factoring transaction. The due from factor, in the case of the person who sold them, or the due to seller on the part of the factor will usually retain an amount of receivables that's going to protect them against sales, discounts, and returns. Now, this happens regardless of whether we have recourse or not. So that's why I said, there's different types of risks and that we want to account for those risks differently. So a due from factor is a receivable account, and on the part of the person who sold the receivables. So we sell the receivables, and as part of this transaction, we create a different sort of receivable where this amount of receivable will be returned to us if if the sales, discounts, and returns do not exceed that amount. And the factor has a corresponding due to, which is a liability account. And that means that whatever amount of receivables they held back as part of this transaction to cover sales, discounts, and returns that isn't used by sales, discounts, and returns will have to be due to the person that sold us those receivables. Another issue in here is that the factor will assess a fair market value of the receivables it does not advance as cash, the ones that it withholds. Think of this as an estimate on the ability to collect on the accounts they are holding back. So they may have a book value of $10,000 when we sold them, but the factor believes that they're really worth $8,000 for various reasons. Now, understand that when we're talking about receivables, and I lump this under accounts receivable, but this could also be any sort of receivable. We have to determine then the fair market value as the creditworthiness of these receivables. Any of the sales and discounts and returns are already theoretically taken care of by the factor withholding an amount that is the due to the seller or the due from factor. And so this is just a sort of additional way that the factor guards itself from the risk of these receivables not being stated at their fair market value. The factor fee, just like any financing institution, there's going to be a fee on top of all this. And that factor fee is going to be a part of the loss that we recognize on the sale. And the gain or loss on the sale is going to be just like we would recognize if we had a gain or loss on PP&E. It is going to be the amount of the book value of the receivables, and then the cash price we get paid. The difference between those will typically create some sort of a loss. But we'll look at where that comes from and how to account for it in just a second. When there is no recourse, the loss is typically going to be the fee charged by the factor and any discount of the fair market value from the book value. So it's going to be a combination of these two items is going to be the loss. And that just arises because, as we'll see in a second, this is the only part. So we look at what we gave up in terms of assets. We gave up receivables. We get entitlement to cash, which we receive right away, and then the due from, and the difference between the amount of the receivables we transferred and the assets that we received is going to be the loss on sale. So look at an example of factoring without recourse. We have Merrick factoring $40,000 of receivables to KLP without recourse. KLP pays Merrick cash in the amount of 90% of the book value of receivables and holds back 10% to guard against sales returns, discounts. Merrick deducts his factor fee of 2% from these withheld receivables. Merrick assesses the fair value of the withheld receivables, the 10% that it withheld, at $3,500. So record the journal entry for Merrick and KLP. So Merrick is the one that's sold. KLP is the factor. And I give you both sides of it because you sort of want to see the whole story that's going on here. And of course, also to appreciate the symmetricity, the symmetric nature of accounting, right? So we sold 40,000 of receivables. Since receivables are an asset account, we'd want to credit them. This reduces my receivables on sale. And of course, KLP, the factor, now takes these receivables. Notice how different that is from the assigning relationship when we just borrowed on the receivables, but didn't actually take them off of our balance sheet. We get 90% of those receivables in cash, so cash in the amount of 90% of the book value. So this 36,000 then is just 40,000 times 90%, and that's going to be my cash amount. And of course, that increases an asset account there. Merrick shows that KLP shows that it gave that cash by crediting that cash amount. All right, so now the two other areas that we got to look at now is the due from, which corresponds to the due to. So Merrick records this again as a receivable. We are expecting $2,700 of assets from KLP. KLP shows this as an obligation. They expect to pay Merrick $2,700 of assets of some sort. So they hold back 10% of the receivables to guard against sales returns discounts. So 40,000 times 10% then goes to the withheld receivables. And then we learn a little bit more about that. It says that it deducts a factor fee from the withheld receivables. So 2%. And typically all these percents are going to be based on the book value of the receivables transferred. So 2% of 40,000 is going to be the loss. So that turns out to be 800. And it says that Merrick assesses the fair value of the withheld 10% of receivables at 3,500. So the book value of those receivables is 4,000. However, the fair value that they're assessing of this is 3,500. So what they're doing then, in essence, is taking another $500 off the top. So this is my fee, call it a factor fee, and this is the difference between book value and fair value. So all of this gets combined in terms of deciding how much to express this due from factor at. And it turns out to be $2,700. So we have $4,000 of withheld receivables. We really only have $3,500 because KLP assesses that that's only worth $3,500. We then take off our factor fee of $800, and that leaves us with the $2,700 of a receivable in the case of the person who sold them, and a liability in the case of the person who bought them. So as long as KLP doesn't have sales discounts and returns in excess of $2,700, they will refund that amount, but only up to that amount. And then now we have a loss or revenue. This is revenue to KLP because this is their industry, and so this is part of their operations. It's a loss to Merrick because Merrick is not, unless they're a bank, they're not in the business of selling their receivables to another company. But this loss arises from examining what we gave up. It's the same as any other loss we've looked at. It's just another way of saying it. What we got. So we gave up $40,000 of receivables, and in return we got $38,700 of assets for cash and a receivable. And so we ended up losing $1,300. And that's the loss. So that decreases my net income. And then for KLP, our loss is their gain. But again, we call it revenue for them because they're a factor. So now I move forward from that and I say, same transaction. Suppose that KLP reports to Merrick after collecting all of those accounts that were factored. KLP provides documents revealing that $1,000 of sales returns and $500 of sales discounts were taken. What journal entry needs to be recorded? Well, what we need to do then is extinguish the due to, due from. And when we do that, then we want to get rid of it at its book value. We booked it at $2,700. Now, what used it up, right? Well, if we had in total $1,500 of sales discounts and returns, then we would receive $1,200 of cash back. We do record these sales discounts and returns even though we sold those receivables. And the reason is when we booked those receivables, we recorded the revenue originally. And so when it comes up that those were not revenue events because of a discount or a return, we want to record the follow through Um, cash of 1,200, we debit that because that's the amount that we would actually get back. They would either give us back, and then this is one of those situations where we would either get back a little bit of cash or accounts receivable. So remember, because they withheld those accounts receivable, they would either give us back those items as cash or the accounts receivable themselves. KLP reduces the due to Merrick account. They would give up that cash and also credit the accounts receivable because they would not be able to collect on the 1,500 that were sales discounts and returns. This could also be sales accounts, or sorry, cash or accounts receivable corresponding to the cash or the asset that they give back to Merrick. Factoring with recourse is when you sell something and you still are involved in it. So in this case, the seller is going to guarantee payment for any uncollectible accounts. This just introduces one more item, which is what we call the recourse obligation in the case of the seller, or the recourse benefit in the case of the purchaser, the factor. So for the seller, the recourse obligation is going to be a liability account, and it's recorded to recognize the probable payment to the factor for uncollectible accounts. Right? Now remember, the due to receivable and the due to liability, or the due from factor receivable, covers sales discounts and returns. The recourse obligation is talking about bad debts, so uncollectible accounts. There's different types of risk that occur with accounts receivable, and we have different facets of the deal set up to deal with either one. For the factor, this is a recourse benefit because it represents the fact that in case any of the uncollectible accounts are coming, are part of the batch of receivables we bought, then we are due cash from the seller to cover those uncollectible accounts. And again, different risk from the risk that's covered by the due to factor. And we want to add this to the overall loss on the transaction. Why do we add it to the loss? Well, again, what we're looking at is what we get versus what we gave up. And what we're getting this time is two assets, or in most cases, we're going to get cash. We're going to get a due to, or due from in the case of the seller. And then now we're also incurring a liability, which is the recourse. And what we gave up is going to be the accounts receivable. So if this amount is greater than that amount, we get a gain. But if this amount is less than the receivables we gave up, then we get a loss. And so as you can see, if we're subtracting here, this is increasing our loss. So factoring with recourse, suppose we had the same information, except that now we assume that we have recourse, and the recourse represents 4% of the accounts that we're factoring. So we're factoring $40,000 of accounts. That sets the recourse at $1,600. Notice this loss now is the fee, the market adjustment, and the recourse. So it's increased by $1,600. It was originally $1,300 of a loss, but now this extra liability creates more loss. Right? Everything else stays the same. And again, the recourse obligation is reflected as a recourse benefit over here on KLP's accounts. And where did I get that from? Remember, it's just the 40,000 times the 4% agreed upon recourse. Okay. Now we're going to look at the end of the transaction again. Assume that KLP has collected on all accounts factored, and they inform Merrick that while there's no discounts or returns, okay, $1,000 of accounts were deemed to be uncollectible. Provide the journal entries. So in this case, since there are no returns, then we would just either get back cash or the accounts receivable that were held back as part of the factoring transaction. We wipe out the due from, the receivable. We wipe out the due to, the liability. But everything comes back as cash because there were no discounts or returns. Now, the $1,000 of accounts were determined to be uncollectible. That's going to deal with the recourse obligation. So if $1,000 accounts were uncollectible, that means that the seller, Merrick, is responsible for that $1,000. So they have to credit cash by $1,000 since they're giving it over to KLP as cash. And we have a recourse. We had a recourse obligation of $1,600, but we were short of that $1,600. And now we're going to recognize the difference between those two as a gain on reversal. Why a gain on reversal? Well, when we book the recourse obligation, remember, if we sort of take out all the surrounding players, what this recourse obligation did, remember I said it added to the loss and created the liability. Well, we recognized a loss of $1,600 thinking that we were going to use $1,600 of the recourse. Since we didn't use $1,600, then we want to reverse some of that loss. We only used $1,000, so we reverse $600 of that loss with a gain, and then we come out with a $1,000 overall loss after we consider this gain. And then KLP, the financer, would extinguish their entire recourse benefit asset by crediting it, and because this recourse benefit added to their overall revenue originally, increased it by $1,600, we now want to reduce it by $600 to show that that recourse benefit really only benefited us by $1,000 overall, that $1,000 cash. Okay, let's look at just a small example and presentation analysis of receivables. Sorry, right before this example, we have different types of if we have different types of receivables, they should be segregated if they are material. If they're immaterial, then disclosure by footnotes is acceptable. What kind of different types of receivables can we have? Well, we talked about trade receivables versus non-trade receivables. Remember, transactions with clients and customers versus transactions with other parties or within the company. Assigned receivables versus unassigned receivables. Assigned receivables have been assigned as collateral versus those that are unassigned are just normal receivables that can be that we're going to collect on, and we can use the cash from those collections for whatever purpose we want. Any valuation accounts should be offset against the appropriate receivable accounts, and anything that's designated or pledged as collateral should be disclosed in the footnotes. So let's look at this. Ranger decided to factor $500,000 of its receivables to First Factor. First Factor remits 90% of the receivables as cash and withholds 10% as a cushion against sales discounts, returns. First Factor deducts its factor fee of 3% from the value of those withheld receivables. So it's going to take that off the top of what it withholds and determines that the fair market value of those 10% was actually $45,000. So let's look at it from Ranger's perspective, and then we'll transfer over to First Factor's. So Ranger would get cash, right? Well, first we're giving up $500,000 of its receivables. So the accounts receivable would be credited by that amount. And we receive 90% of the receivables as cash. So 90% of 500,000 is 450,000. And when we do this, then we also have 10%, right? The remaining amount, the 50,000, is being withheld. So the first thing that is probably more sensible to look at is to say, well, this 10% withheld is judged to only be $45,000. So that's that market book to market conversion. Market first, book to market conversion. So they only think they're going to get 45,000 out of that. And then they also withhold a factor fee of 3% from the value of the withheld receivables. So 3% now of 500,000 is 15,000, and we have 30,000 now remaining. This is the factor fee. So this is our due from factor. Which means that the loss on sale, if you just look at this, because there is no recourse, the loss on sale would be the 20,000. Well, where does that 20,000 come from? It comes from the $5,000 book to market conversion and the factor fee that is assessed. And again, you can also think of it in terms of what did we give up and what are we getting? We gave up something worth 500,000. We're getting assets of 480,000 from that. And so that's the loss on sale. Lots of ways to think about it, right? Ranger Company, first factor, it becomes pretty easy to translate if you really think about just the nature of your entries here. Well, if Ranger Company gives up that cash and first factor receives it, if they sell those receivables, then first factor is also receiving those receivables. Accounts receivable of 500,000. They gave up cash of 450,000 to obtain it. And then the due from factor is 30,000 for Ranger, so that's what they expect from first factor. Well, then that's what first factor would record as a liability, the due to Ranger. And how much of a gain or loss on sale should they record? Well, they got something worth $500,000 for giving up 450,000 and incurring a liability of 30,000, so they came out $20,000 ahead. But again, we call this revenue because this is their operations. They buy receivables, they buy instruments and sell them, they make investments, etc. So anyway, that is financing with receivables and the two ways it can be done. Make sure that you are able to do both ways, of course. Make sure that you're able to settle up the transactions, the due from, the due to, and also the recourse, benefit, or obligation, and how that works at the end of the deal, because that's something that is also important to understand. And that is all for Chapter 7.